worked with a lot of Ontario businesses, Robert, preparing to sell. Before we dig into your framework here, um, the 10 drivers of pre-sale value, why do they
Yep.
matter so much? Like what changes when an owner starts prepping early
Yeah.
versus, sorry.
Yeah. Well, I think the reality is selling a business is very hard. It's probably one of the hardest, transactions that a business owner is ever going to go through because it's quite emotional. There's a lot of money involved. There's a lot of different costs. And so what we end up finding is that, if you look at the stats, there's no real clear answer, but you call it 50-50. There's a 50% chance that that deal actually may not go through. So part of the getting ready for sale is actually just increasing the chance of, you wanting to sell your business and successfully getting to the finish line and avoiding the years and the potential pitfalls that come along the way. Because we've all had a friend or a colleague or heard a story where a business owner has tried to sell and it's gone wrong, and then they've been hurt, their business has been hurt. So really being ready reduces the risk of you going through an unsuccessful process. So it's all it is just time and work. Honestly, it's not the things that we're going to talk about today are not complex. It's really just being top of mind and being actually ready to focus on those things. So
Yeah, I often find like when I'm talking to clients, not just about selling business, but just about anything, I often just say to people like you wouldn't travel to an unknown location without a plan.
that's
Um,
right.
so like you just don't want to come to a point and end up selling your business like without a plan.
That's
Um,
right.
so you often say that owners should move beyond notice to reader statements or compilation of financial information now and really invest in monthly tracking. And why do you feel that that is such a game changer for buyers?
Yeah. Well, I would say the most common reason why deals fail is because there is an information gap problem between what the buyer expects to receive from the seller and what the seller can produce from their business. And that really boils down to financial information, not only on an annual basis, but also on a monthly basis. So a lot of what we do years in advance with business owners is actually just helping coach them on tracking their data more accurately so that when the buyer is going to go in and going to ask you, well, how do you make money? What are your most profitable customers? What's your most profitable job? What's the job in the pipeline that's going to be most exciting? And you're going to say all these things in that conversation. They're going to trust you at that stage in the process. And they're going to say, fine, I believe you. I'm going to make you an offer. But at a certain point, all those statements that you've offered up need to be really actually verified. And so if you can't produce the information, that's where you hear these stories of, well, the buyer lost confidence, or the communication broke down because one side couldn't get the information they required. So what we spend a lot of time with is just helping business owners understand that monthly bookkeeping, tracking that data is so key, especially a couple years in advance, because the more data you can supply to a buyer, the easier that buyer is going to feel that they can understand your business and get comfortable with your business because they're taking a leap of faith. They're assuming that what they're buying is sustainable, it's healthy, it's profitable. And if you can't supply the information to prove that, then they are not going to buy your business and they'll walk away.
Exactly. I can tell you a story of a client who recently became a client that was going through or had gone through exploring selling his business, and the prospective buyer was asking questions, and the feeling he had when he couldn't, not only when he couldn't answer the questions that was being asked, but even some of the questions he had no clue what they meant. And this is a business that is now selling for multi-million dollars, but yeah, it is important. So do you think, if for a smaller business, like at what point should an owner think of bringing in a controller, or a CFO, part-time or full-time?
Yeah, well, that's the first recommendation we make when there is a situation where the numbers are not so strong. Is most businesses probably under, call it even 20 million, but for sure under 10 million in sales, they can't afford the full-time cost of a full-time controller or CFO. They generally have a bookkeeper and maybe they're doing the bookkeeping themselves and doing the month-end reporting. So really bringing in someone on a part-time basis to spend 10, 20 hours a week in that business to actually start generating some of these reports and elevating the quality of the financials is the best thing to do. And you probably want to do that at least 2 years in advance. Generally, buyers are going to look back about 4 years in the past at the numbers, at least. It's not 10 years. It'd be nice to have 10 years of information, but really within 4 years, a buyer can really sense the quality and the trends of that business. So, but at a minimum, I would recommend 2 years to really bring in a part-time CFO or at least to upgrade the quality of information.
Because buyers will look at the historical financial information in an effort to try and predict the future cash flows, which is
That's
where
right.
the valuation comes from, correct?
Yeah, that's right. Well, and valuation in itself, the easiest way to think of valuation is there's the profit and the numbers and all that kind of stuff. The most important driver of valuation is transition risk. What is the risk that your business presents to a buyer? So if that business can't produce information, you can't really supply and explain how it makes money, then there's a risk in terms of I don't understand how I'm going to be able to transition this business because you can't even communicate it to me. So I'm not comfortable. Versus if I can slice and dice the information and tell you what these customers have done over the last 10 years, I can more easily get comfortable with those numbers and get comfortable with that transition risk.
And I guess another one, I'm sorry, like another big transition risk, as you're putting it, would be separating the owner from the business. Like, so to remove the owner when possible out of the relationship, because like if the owner goes and the business is going to die, there's no value there.
Yeah. Yeah. So that's number two. So number one is cleaning up the financials. Number two, the biggest driver and the reason why deals fail, but also the reason why you can increase the value of your business is if you can figure out a way to not make yourself the business, but actually remove yourself out of the business. And that's really hard. That's actually harder than cleaning up the financials. What we try to do is we try to bring in a recruiter or an HR consultant or someone to sit down with you because generally when you tell the business owner, hey, you're too key to your business, they've heard that before and they've tried to do it before and either they failed or they don't know where to start. So bringing someone that can actually help them figure that out is one of the easiest ways to really try to change that. And so our most successful clients are the ones that bring in a general manager or bring in a strong number two leader within that business a couple years in advance. And when we go to sell the business, buyers are going to look at it and say, wow, you've done half my job for me. You've reduced the transition risk and figured out how to get yourself out of the business. I'm going to pay you more. I'm going to give you more money for your business.
Yeah, I think we find on our side the hardest thing to do is convince owners to relinquish a little bit of control. They don't have to be in control of everything, and this is a good point of why that's important.
Yep.
Um, you also talk about the basics like websites, branding, and even cleaning up facilities and stuff like that. Why do those details matter to buyers?
Yeah, so this is more of like a first impression. The reality is, business buyers are not looking at just your business in isolation. They're looking at 10 different opportunities at once and really deciding, well, do I like company A more than I like company B? Which one am I really, do I see myself owning and being an owner of? And so part of that is when you walk in, if the place is dirty and grimy and there's a puddle in the middle of the lobby and the back looks just like disastrous, maybe there's some buyers that look at that and say, wow, cha-ching opportunity. But that also means probably they're going to pay you less for your business, and probably the majority of them are going to look at that and say, whoa, this is messy. Like this business needs a lot of work, and most people actually would rather pay for a turnkey business than pay for a turnaround opportunity. So making your business more turnkey in terms of doing some of the work, because all we're trying to do is bring some of the playbook that the buyers would apply to that business a couple years in advance so that you can do it as the business owner and then increase the value of your business. So the easiest one is websites. Like sometimes we've sold businesses that have had no website. I mean, how can you go and sell your business to a buyer? Because the first thing they're going to look up is your company online. And if they can't find a website or they find a really old website, they're that excitement or the ability to understand what you actually do and what makes you special, it's going to be harder to really understand virtually. And so there's going to be more selling needed, and you're going to need to do a better job in person because online your digital footprint is weaker. So those would be some of the low-hanging fruit that you could do to clean up years in advance.
I think like what you're saying is exactly like for the layperson, like when you go to buy a house, right? Like there's going to be a certain segment that will look at a fixer upper and go,
Yeah.
oh, that's great. But the majority of people don't want a fixer upper. They want, something clean and stuff. And yeah, I think I was just about to say something else too, but yeah, yeah, sorry. I just lost my chain of thought there. But oh my God, squirrel. So you also talk about the emphasis of cleaning up the balance sheet.
Yes.
Um, Things like writing off bad debts, old AR, looking at that, clearing out stale inventory. I got stories about stale inventory as well.
Yeah.
Why is that such an important step in prepping for a sale?
Yeah, so that's actually probably one of the most forgotten areas of pre-sale readiness. The first two are easy to cover in terms of cleaning up the numbers and owner concentration. I think many people have heard that. The place that's forgotten is the balance sheet because everyone focuses on the income statement and says, "Well, here's my revenues, here's my profit. This is the value of my business." But what you have on the balance sheet is your cash. You have spent your cash, your profit that you've earned on inventory, or it's tied up in accounts receivable or other current assets. And so, what we try to focus owners on is trying to be more efficient with your cash so that you spend less on inventory, you collect quicker, because the reality is when a buyer is going to buy your business, what they're essentially saying is, I'm going to pay for this profit, but you're going to give me a normal level of working capital. And we could spend a whole hour on this, but essentially what that means is it's the gas in the gas tank of a car, meaning the working capital of that business that you are going to use to generate the profit for your business. Buyers are going to expect that you're going to leave a certain amount behind. And so what they're going to do is they're going to historically look back at how much working capital you've actually used to operate your business. So if you've been a little lax in terms of collections and you've overspent on inventory and you don't really need to buy all these things, but it's like, well, I saw a deal, so I'm going to buy 3 years worth of this stuff now. It becomes harder to actually convince that buyer when you go to sell that you didn't need that cash to be spent on that inventory. So if you lean up your balance sheet and collect more quickly so that your AR is cleaner, your inventory is less, then you have less cash on the balance sheet. So you have to give less to the buyer when you sell that business ultimately. And so when business owners do this, you can actually unlock, I'm talking hundreds of thousands of dollars simply by just being on top of your receivables. Because now you've demonstrated that your business doesn't need that amount of accounts receivable to generate that level of profit. So that would be the first one. I'll give you a live example right now. We're working right now with a very niche industry, auto wrecking. Okay, auto wrecking. So they buy cars from auctions, they break them down, they sell different components to primarily mechanic space, and so they have no grasp of their inventory. And literally, what they report on the balance sheet is call it 500,000. And when we ask them what they really think the value of the inventory is worth, well, it's probably worth 4 million. Okay, well, when you go to sell that business, and we're telling them not to sell it right now because they need to totally clean this up, buyers are going to look at what you have on your financials and say, well, you only have $500,000 worth of inventory, so you need $500,000. Whereas you have $4 million worth of inventory that you're trying to maybe get paid on, buyers are not going to believe you because you're not tracking it. You're not cleaning it up. So the more detailed you are with your balance sheet and the more efficient you are there, you can save millions of dollars. And it's oftentimes forgotten because no one pays attention to the balance sheet except the CFOs and the CPAs.
Right. Which is into the first thing we talked about, tightening up your balance sheet, right? Like so.
That's right.
Um, yeah. I can tell you stories of clients where, you go into the warehouse and the inventory has a layer of dust. So you really as a CPA, you question, like when's the last time you sold this, or like what is the true value of it? So, uh,
Yeah.
and if we're going to talk about customers and suppliers, like what's the ideal picture that buyers like to see with respect to those two groups?
Yeah, well, firstly on customers, like the first thing we want to get across, especially with business owners, is sometimes people are focused on, the revenue number. I know I got to get the highest revenue number to sell my business. Sometimes it's even profit, and I got to get the highest profit number, whatever the case is. What we try to shift the focus towards is revenue quality. So the quality of the dollars is really important because you could have a $10 million revenue business with $1 million in profit, $10 million business with $1 million profit, and those businesses would sell for very different numbers because of who you actually sell to. So the quality of your revenues is critical. And so what we try to coach business owners on is number one, from a concentration point of view, you probably have grown with one or two key customers that have helped you get to that next level. But the reality is the bigger that customer is of the total pie, the riskier the transition risk would be. So generally business customers that are more than 25% of your sales would be seen as key and risky. So you want to try to reduce those relationships by diversifying and finding other accounts so that you're under that 25% threshold. And then as well, you want to be chasing the right type of work. So a really good example, say for example, you're a metal manufacturer and you have the option to work with this company that's going to give you $20,000 worth of orders, but they're going to order from you every single year. Versus this company that will give you a $50,000 job, but probably won't come back to you for a couple of years. Yes, this is a $50,000 job, but this $20,000 order that keeps coming in every year and is recurring in nature is actually worth more as a customer than that one-off $50,000 job. So the recurring level of your customer relationships is key. And so what we really want to see is if your top 10 customers in last year are similar to your top 10 customers this year and year over year over year, they're staying with you, that's a healthy customer list. Versus if your customer list is very spiky and it jumps all over the place and there's new names all the time, then you're working really hard to find the next customer versus relying on customers just coming back to you because they need to come back to you. So revenue quality is the number one thing we tell business owners to focus on. Chase the right type of customers.
Yeah, I think it goes back to the predictability of future cash flows. If you have that recurring customer, like I often tell clients, like you can't leave your dentist before the dentist knows the next time he or she's going to receive money from you. Like they book you your next appointment.
That's
And
right.
and then you kind of also touched on another thing about quality, and we see it all the time when we're doing year-end stuff. You can have really great sales and then really high AR, and if the AR is really old, it's just an indicator that you're perhaps selling to the wrong customer. Like you're more focused, like a salesperson, you're focused on the revenue, right? So,
That's right.
but you're never going to collect. That's not a good thing. Um,
Yep.
um, what about legal disputes? Like how, like what's the best approach with dealing with legal disputes before a sale? Obviously, not having them would be probably the best approach, but they happen.
Yeah, from time to time they happen. Really the key thing is it's how big is the legal dispute. So generally, and for Canada in particular, you really want to sell the shares of your business because of the lifetime capital gains exemption, which means that up to 1.25 million of goodwill, you get that tax free. So every business owner that wants to sell generally wants to sell the shares. The challenge is the reason why we see asset deals, one of the big reasons is legal disputes, where there are certain liabilities associated with that company. You're in dispute with the customer, with the supplier, with employees. And number one, not only is it representative of probably it's a bad first impression if your employees are suing you or your customers suing you, because wow, what type of business owner are you? But then number two, it gets in the way of you actually being able to sell your shares. So, we had this one situation where this business owner was in a dispute with a customer and it was dragging on for years and years and years. I'm talking like 7 years, and it was this $1 million lawsuit. And the business owner was really kind of, oh, I gotta win. I'm going to prove him that I'm right. It's no, 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 no. I'm going to do this. And we went to market and we tried to sell the business. And the reality is that every buyer came back and said, I'll buy the business, but only the assets. And when you ran the numbers, the tax savings that he was giving up just didn't make sense. I mean, the tax savings, he had a family trust set up and he would have paid an additional probably $1 million in tax by not resolving this case. And so we went back to the owner and we told him, well, listen, if you settle this and just clean this up and just pay 200 grand, you get $1 million in tax savings by selling the shares instead of selling the assets. And that's a perfect example where probably you need to settle those things or clean those things up so that you can actually access the benefit of selling shares instead of having to sell the assets because the buyers don't want to assume your liabilities.
Hmm. Yeah, so true. Sometimes people get principle gets in the way, or even like I had a client who did very well last year, like in terms of 2024, in the stock market, and had 1.8 million dollars in gains, and he had 400,000 of tax, and he was just complaining about the tax he was paying, and I offered to pay his 400,000 of tax if he gave me the 1.8 million dollars of gains.
That's
uh,
right. That's right. Yeah,
like focus, you still have 1.4 million more money in your pocket than you did, at the beginning of the year.
that's
Um,
right.
it's important to focus, the vendor on the important issues and get them out of their own way sometimes.
Yeah, I mean the highest return for your time as a business owner when it comes to preparing your business for sale is tax. Yes, all these things that we're talking about, they're really good things to do, but they take years. Like to improve the quality of your customers or to find that general manager, to clean up these statements. I mean, that's months and months, if not years worth of work. Within 4 to 6 weeks, you can set up a tax plan and do a reorganization. That should be the first thing you do. And yes, there's a little bit of cost to it, but the return on investment for that cost, if you do it early enough, is significant for most people. And the reality is, it's kind of like going to the dentist. Everyone's like, "Yeah, yeah, I'll do it. I'll do it when I need to do it." But the reality is, when you need to do it, it's too late. So you should be doing those things at least, 2, 3, 4, 5 years in advance, so that the tax plan's ready. And when that person comes knocking with the best offer ever, you don't have to do anything around tax, because by then you can't even do it, and you can take advantage of that tax plan that you've set up. So that's the highest ROI. So I'm sending them your way, Trev. Definitely they need, every business owner, like, I'm going through a tax reorg right now. I have no interest in selling any of my businesses, but I'm doing it right now. $5,000 to do this reorg plus the legal work for another three, 10 grand. I'm like, I could save the 10 grand and, spend it on a couch. But if I just do it now, I get it out of the way and I'm ready for when I need to sell.
Did you say
So
a couch? That
that's
must
right.
be,
I'm looking at a fancy couch.
that's a
It's a
fine-looking
fancy.
couch.
It's a big one. It's 120 inches long. You could lay two bodies across it. It's like 4 grand. I mean, these couches are expensive nowadays because I'm also trying to buy Canadian.
Yeah, no, when clients come to us when they're thinking of incorporating, we often like tell them to think like big picture. Just don't do the out of the box, white label, common shares kind of deal. Like let's think with the future in mind and potential succession or whatever, and set up, because like us being frugal accountants, like doing articles of amendment will cost you like $1,000, $2,000. But if you can kind of plan for that when you're setting it up, it's done. And
Yeah.
yeah, so and back to the 5 or 6 weeks to do a reorg, yes, but there's a lot of tax planning that you want the reorg in place probably 2 years or more in advance of the
Yeah.
actual transaction happening. So
Yeah, I'm saying more around the time and effort to like do the work. So if
yeah,
you do the tax reorg versus try to hire a general manager, it's going to take months to figure out finding if you found a good general manager versus a couple weeks to do the tax reorg. Like the
yeah.
quickest and speediest way to save tax and get return is doing the tax. So
And it's potentially one of your biggest expenses in your business.
that's right. That's right.
Um, how are we doing on time? We're doing not too bad. I think we're
I
almost.
could do this for hours, Trev. You just keep going. You tell me, but you bring the hook and pull me off the stage.
Well, I think Zoom has a limit of 100 hours for our meetings, so we got to keep on.
Okay, we'll keep
Um,
it under 99.
yeah. Um, when like I think you kind of touched on this a little bit, but when's the right time to bring in advisors like you guys or accountants, if you or even considering like different accountants, if you have kind of a smaller operation. I think accountants, just shameless plug, that have experience doing this kind of stuff or doing reorgs or stuff like that, that should be a consideration too. But overall speaking, like how early in the game do you want to, like, is it right
Yeah.
after you wake up one morning and go, I should sell this business or I can sell this business?
Yeah, I would say the minimum, absolute minimum is 2 years. And realistically, like we're talking to business owners that are in their 40s that want to sell in 10, 20 years, but they're just having that regular conversation with us. And really in terms of like it's I recognize one of the things that our clients always say is it can be very overwhelming to try to figure out like what do you do first? Like the sequence of events, the first thing is you want to make sure you have a good accountant. Like, you don't want to work with that local single shingle high school friend that doesn't do tax and is not proactive and just, is the cheapest person on the block because you don't want to underinvest in that advice. You want to make sure that you have a really good accountant that is going to do the tax first, as I said. That is the best bang for your buck and do that years in advance. The second thing, though, is you should probably talk to an M&A advisor, someone that, again, can tell you what your business is worth today and can give you some feedback around, well, what should you do now to ready the business for sale eventually. So when we talk to, that 40-year-old business owner that's scaling at 20% a year, we're really focused on building the team, building the strategy, getting the story right so that when they do want to sell, all of those things are in place. So, that's probably like if you don't know where you stand now in terms of what your business is worth and what your weaknesses are, how are you ever going to start preparing a business for sale? You almost kind of need to do that general assessment checkup first. And that's where we come in. Like one of our biggest value adds is, we're trying to, really combat the stigma around business brokers, which historically has been that, real estate agent, very transactional, call me when you want to sell, and here's my engagement letter in the first meeting, to just call us and like we will educate you. Like we will talk to you and really kind of help you understand what are the things that you should do. And I think count it first, and good M&A advisor second, and then after you talk to those two people, you'll have a plan to then follow through, and the rest is on you. The rest is on you, and that's actually the hardest part of it, is actually following through on all this advice that you're going to get.
And have you come across like clients that where there's more than one owner, like there's a partnership, like partners
Yep.
involved or whatever, and they're starting to think about selling their business, yet they don't have a partnership agreement in place?
Unfortunately, yes. Unfortunately, yes. So that's one where, honestly, we're almost like a mediator. Like we're kind of like a psychiatrist where we come into these situations, and what we try to do is we'll meet with a group, and then we'll actually meet with each individual person and really kind of pull out what they privately can't share with the rest of their partners, or what they may fear saying and hurting their feelings. And then we try to assemble everything and really try to get a game plan to say, roughly, here are your timelines. Here's what the expectations are. This is probably the path forward. So again, like it would be nice to have that partnership agreement. We strongly recommend that that's set up, even if you're kind of in the middle of your business career and you're 5 years away from selling, just even having like a rough rules of engagement around, well, if I disagree and you agree with this, how do we decide? The more structure there is, the less dramatic that sale process could be. Because there's just so much emotion. Like, 30% of this job is numbers, 70% of what we do is the feelings and the emotions and communication, and just helping people really kind of put words to what they're feeling.
Yeah, we have experiences with, our clients that, you know, just like marriages, sometimes they don't end up well. And you'd be surprised at how many people don't have agreements that, and almost like a prenup. Like a prenup is there just to kind of deal with the end of the relationship. And same with partnership agreements. Like there's, a lot of roles and responsibilities, but it's a lot easier to do a partnership agreement when you and your partners are still in love with each other and rowing the boat in
Yes.
the same direction. It's impossible to do it like when you hate each other, and
Yes.
even worse, it's impossible to do it um, when one of the partners dies. Like either, well, usually suddenly, but like either in the middle of a transaction like this, or even if it's just two people, and then all of a sudden with no partnership agreement, now the surviving partner is new partner is the spouse of the old partner, and
Yes.
that's always air quotes fun.
Well,
Um,
it's funny. So in our job, we see all these situations unfold. So I am like one of the most prepared young people. It's funny. Like I literally have a will with a plan for my unborn children already, because I've seen like that's another thing that some business owners, they're going to sell and they still don't have a will and they're in their 60s. Like get that done. Like in life insurance, whole life insurance in the hold co. Like all like I have one, and I'm not going to die for, hopefully knock on wood, many years. But it's all planning and it's all time. And in the moment, you're like, oh, this is like so boring, and I have so many more important things to do than this. But once you get it done, it's off the plate and you got the plan. So it's just
yeah.
about being ready. That's all it is. And that's the point of this conversation. So
And no one wakes up in the morning figuring they're going to have a car accident because that's why they call them accidents, right? So
that's right.
yeah,
That's right.
better be prepared. Um, do we have any questions, Rebecca or Kate?
We have asked the group that they can feel free to let us know if they have any questions. In the meantime, I have one for the two of you. So it's really interesting to watch, watch and listen to the conversation. I'm just wondering, is there a benefit to business owners to be able to work with a team of people that know each other and have a bit of an established relationship as the two of you do, what does that look like? If the two of you are guiding a business owner through a transaction in comparison to a situation where that relationship's not already in place.
Yeah. No, it's a good question, Trev. I'll steal that one if you don't mind, because I think it's one that as I've gotten more comfortable on what I do here, I like one of the things we do proactively early on in the process is we reach out to all the advisors and set up one-on-one calls and just start to build that relationship. So it'd be nice if that team knows each other already when they all come together, but oftentimes there's just so many providers in the space. But having those one-on-one calls, so we'll reach out to the lawyer and we'll say, hey, this is who we are. Here's a process. Here's how we're going to run this process. Don't feel like, we have to, this is our turf and this is our section versus this your section. The moment you can kind of break down those walls and encourage those one-on-one calls, when providers are talking to each other, it's just more efficient and it saves money for the client. Because now instead of the one provider going in one direction and the others going in this direction, they're coordinating their activities together. So that is it kind of you need to set the ego to the side as a provider just to kind of reach out and build that bridge for communication. But it does save a ton of time and money for the client.
Yeah, I think like what Robert was saying, like there are a lot of people in the space, and what we try and do at GBA is always, be a disseminator of information or a sharer of information and collaborator. But like if you do know the person, the lawyer or the M&A people that you're working with and have like we all have as service providers and dealing with other professionals, we make our own judgments on who's like better than other people. Like everyone should be hopefully competent, but there are some that are more attentive to detail. I'm talking lawyers now, right? And like we'll always like when we tell people about like a corporate reorg, we say let us give you the tax plan, and then we'll communicate that with the lawyer, and the lawyer will paper it to make sure it's done like from a legal point of view. But if we give them the tax plan, we'll always review the paper before it's signed off, and you'd be surprised how many revisions we have to go through with some lawyers just because like no we said this and you still have it, like you haven't changed that yet. So
Yeah.
I think working with someone where some of the professionals know each other, there could be a gain level of trust between them.
Yeah.
But
And one thing that I learned, so my partner in our business, Thomas, he's a master closer. And one of the things that he does really well, and I've started to implement as well on files that I work with, is actually having a weekly touch base call, even if it's 5, 10, 15 minutes. As you're going through that deal, people are just working on so many different things. Just bring everyone together and have a 5-minute Friday call. Like, how's everyone doing? Like, what are you working on? What are you working on? And people will say, well, I'm working on this. And like, well, hold on, I thought I was doing that. And then so there's less doubling up of work. And so just like, don't just rely on emails because I find emails, it's just a really long monologue. It's better to actually just bring people on calls and have that weekly check-in as you're going through a transaction or whatever activity you're doing.